All right, let's jump right in. We're going to pull back the curtain on something most of us think is pretty straightforward: financing a car here in Canada. But, what happens behind the scenes is this amazing mix of law, finance, and, well, some seriously clever tax rules that you probably have never heard of. I mean, on the surface, this is it, right? It's the story we all know. You find the car you love, you sign a mountain of paperwork, they hand you the keys, and that car is yours. You just make your monthly payments, and that's that. A simple, clean purchase. Or so it seems. But what if I told you that simple story isn't the whole story? This one little question, it changes everything. It's really the key that unlocks how the entire auto finance industry is built. And trust me, the answer is way more complex and honestly, way more interesting than you'd ever guess. Okay, so let's get right into the first big twist. While you're the one driving the car, you're the one insuring it, you're the one registering it in your name, the actual legal and financial reality of what just happened is a completely different animal from what you experienced. This slide just nails the two parallel universes of a car loan. On one side, you've got us, the buyer, thinking, hey, I'm buying a car. Simple. But on the other side, you have the finance company, which is often what's called a captive finance company, or CFC. Think of it as the car brand's own bank. And from their perspective, they're thinking, I'm just a lender. They see a loan on their books, secured by your car, which is an asset, a piece of collateral, that they never, ever own. So how does this work? It's actually a pretty clever flow. The key is that the dealer sells the car directly to you. You are the owner, right from the get-go. But, and this is a big but, it's a conditional ownership. It's conditional on you making those payments. Then the dealer takes your loan contract and sells that piece of paper to the finance company. So the CFC isn't buying your car, it's buying your debt. And that gives them what's called a lien, which is just a fancy legal term for a claim on your car if you stop paying. It's a really subtle but absolutely critical difference. And really, it all boils down to this one line. This is the golden rule of the whole system. The customer is the owner. The finance company is just the lender. This distinction is everything, because it's the very thing that creates a massive, complicated problem if a loan ever goes bad. Yeah, this whole lender not owner thing, it creates a huge headache down the line, specifically when it comes to taxes. And this puzzle only really shows up when things go wrong, when a car has to be repossessed. At the start, the tax side of things is super simple. The dealer charges you sales tax, the GST or HST. You pay it, and the dealer sends that money off to the government. The finance company, they just roll that tax amount right into your total loan. And your monthly payments themselves, well, those are considered a financial service, so they're totally exempt from sales tax. Everything's clean, simple, no problem. So where's the catch? Well, the problem kicks in the moment that finance company, which, remember, we've established is just a lender, has to repossess a car. All of a sudden, they are forced to become a seller. They have to sell that car to get their money back. And if you're a seller, you have to charge sales tax. But how can they do that fairly when they never owned the car or paid tax on it to begin with? It's a real paradox. This is where it gets really interesting. The Canadian tax system actually has this incredibly elegant solution. The government created a special set of rules tucked away inside the Excise Tax Act designed specifically to solve this exact problem and make sure the finance company isn't unfairly punished. And the hero of this story is a little something called the Notional Input Tax Credit. You can think of it as a phantom tax credit. The government basically says, okay, finance company, when you take that car back, we're going to pretend you paid sales tax on it. This lets the CFC claim a credit that perfectly cancels out the tax they have to collect and send to us when they resell the car. The goal, the whole point, is something called tax neutrality. It means the finance company doesn't make or lose a single dime on the tax part of this whole messy deal. So after repossession, the finance company actually gets to claim two kinds of tax credits. First, there's the big one, the notional ITC, the phantom credit that claws back the tax from the original sale. But they also get to claim real tax credits on any actual money they spend to get the car ready for sale. Things like repairs, auction fees, that kind of stuff. All right, so now let's put it all together. This is where the rubber meets the road. Let's look at how this whole system, the business rules and the tax rules, plays out in the real world when a repossessed car is finally sold. So when that car sells at auction, the money flows in a very specific order, kind of like a waterfall. This is all laid out in the law, in something called the Personal Property Security Act. First up, the costs of the sale get paid off. Next, the finance company gets paid back what it's owed. After them, any other lenders get their cut. And then, and this is a really important point, if there is any money left over, a surplus, it has to go back to you, the original customer. And this right here is where we find the most surprising twist in this entire system. Look at the first scenario. The car sells at a loss. That's pretty straightforward. The finance company uses those tax credits to help reduce its loss. Makes perfect sense. But now look at what happens if the car sells for a gain. The law says the finance company has to give all that extra cash, the surplus, back to the original customer. But, and this is the wild part, the finance company still gets to claim and keep the full notional tax credit from that sale.
Let me just say that again because it's the most mind-bending part of this whole thing. When there's a surplus, the actual cash profit, the commercial gain, goes back to the customer. But the tax gain from that sale, that stays with the finance company. It's a strange little feature of the system, but it's exactly how it's designed to work.
Wow. Okay, we have covered a lot of ground here. From who's an owner, to liens, to these phantom tax credits. So after all that, what are the big ideas you should really walk away with? At the end of the day, it really just boils down to these three different realities, all existing at the exact same time. You've got your reality as a consumer, I'm buying a car. You've got the finance company's reality, I'm just a lender, I don't own this thing. And then you've got this third hidden reality, the tax reality, which is this clever, neutral system designed to step in if the first two ever come into conflict. Ultimately, this whole hidden system is designed for one thing: fairness, tax neutrality. It's not a secret way for companies to make a profit, it's just an elegant solution to a very tricky legal and financial problem. Which, of course, leaves us with one last big question. If a transaction as simple as a car loan has this entire hidden world humming away beneath the surface, what other simple parts of our financial lives have their own complex machinery we know nothing about? Thanks for joining me for this deep dive.